Now that we know what the stock market is, it's time to choose a vehicle for gains in the market. Today we will discuss mutual funds and index funds. Through the year 2019, mutual fund assets globally were over $54 trillion. That's trillion with a T. In the United States, $26.7 trillion are held in mutual fund assets. If you are looking for a way to grow money in the market while minimizing risk, then there is a fund for you. These funds are so useful that they account for roughly half of the assets in retirement accounts. If you are looking for a great place to start investing, allow us to introduce you to the power of mutual funds so that your finances may always stay in the black. Hello everyone, welcome back to yet another episode of In the Black. I'm Troy, and today we are going to discuss mutual funds and index funds. Now last week we discussed the stock market and the history of the stock market. Well, to this week we're going to try to introduce you to what might very well be your very first investment once it's time for you to actually put money into the market. When you start investing, you obviously want gains in the market, but you want to minimize your risk while you're doing this. The best way to do that is to diversify your portfolio. You want lots of different stocks from various companies, both large and small, and in various industries. If you put all of your eggs in one basket, you may lose them if that basket falls. Same thing with the market. The idea of diversifying your portfolio is that you spread your money into various baskets or stocks. Well, what if I told you there was an easy way to do that and invest in many companies at the same time? While choosing one perfect company can result in a rocket to the moon in gains, it can also quickly crash if anything goes wrong. Bad news, they didn't get a government contract they're expecting, the deal didn't go through, or a worldwide global pandemic cripples their industry. You don't want that to happen with your very first investment, so you want to spread out that risk, and that's what mutual funds can be used for. This is especially true if you're trying to pick one single startup company, or if you're just brand new to investing, you want safe, stable investments to begin with, and that's why I believe that mutual funds are a great place to start. Mutual funds allow you to purchase one share of a fund that has holdings in dozens and sometimes hundreds of stocks, bonds, or even commodities. By the end of this video, I want you to understand four things. Number one, what is a mutual fund? Number two, what is an index fund? Number three, what is the difference between an open-ended and a closed-ended fund? And number four, what is an ETF or an exchange-traded fund? Let's jump right into it. A mutual fund is a professionally managed investment fund that pools the money of all of its investors to purchase securities such as stocks, bonds, and even sometimes commodities. The first modern investment funds were established by the Dutch, of course. As we learned last episode, the Dutch were pioneers of stock and investing. In the 1770s, an Amsterdam-based businessman created a trust to pool all the money of the local investors so that they could weather a financial crisis, and thus the modern investment, or what we now know as a mutual fund, was born. Mutual funds made their way over to the United States in the early 1890s, so the idea of mutual funds have truly been around for centuries. Mutual funds are typically professionally managed, so there are professionals in the market working for each fund that work to hit the goals of each individual fund, and they will make adjustments as needed based on market events. When you get a piece of a mutual fund, you get a piece of your own professional fund manager that's going to work that investment for you. With that, of course, comes fees, which are taken out of the gains of the fund over time. So, while you may not notice it directly, the fund is going to take a cent or two from every dollar gained, but that pays the commission for those professionally managed funds. There are, in today's day and age, robo-funds, which have reduced fees even more and use computers and algorithms and AI to predict the goals of their fund and changing market structures, and they maneuver and manipulate those funds as needed for you. Each fund will have their own fee structure, so be sure to find out what the fees are before you place your money in any particular fund. Early mutual funds were closed-ended, and what that means is that there was a fixed number of shares which were not redeemable for the fund. The only way to get your money in and out of that once you buy those shares at the very beginning of a closed fund is to trade those shares on the market and have someone else pay a higher price for them. Today, closed-end funds are listed on stock exchanges and they're bought or sold just like any other stock would be, and their price is determined by the market, which means it's whatever someone's willing to pay for it based on the value of what that fund holds. In a closed-ended fund, those early investors who were there at the fund's creation typically reap the biggest gains over time because they were usually able to buy in obviously at a lesser price, and you're of course hoping this investment goes up over time. Today, closed-end funds function very much like an exchange-traded fund or ETF. Before we get to ETFs, let's talk open-ended funds. The very first open-ended funds were created by the Massachusetts Investors Trust on March 21st, 1924. And it's still in existence to this very day. An open-ended fund means that the fund itself can issue and redeem shares at any given time. These open funds have a share price that is determined to the proportion of all the assets that they hold, which is the net asset value. And those open funds are great for flexibility and allow for steady continued investment over time. While not generally a hard rule, open-ended funds typically represent a safer choice of sorts, while closed-end funds may also produce higher returns. No matter what type you pick, mutual funds have a goal in mind, and it's to provide diversification while maximizing exposure to various markets and minimizing your risk. Long before you could buy a fraction of a share of stock, if you wanted to invest in a lot of different companies, you needed a lot of money to buy a lot of different stocks at a lot of different share prices. That way you would have a diversified portfolio that no one company could go down and you would lose all or a significant portion of your money. Depending on the mutual fund you choose, you can buy one share of a fund that has its assets invested in plenty of companies that allow you to get an excellent diversification. And different mutual funds have different goals in mind. So you want to keep that in mind when you're researching and doing your due diligence when it comes to which fund you're going to pick. What are your goals? Do your goals align with that of your mutual fund? Some mutual funds even have their assets directed at entire sectors, such as the index funds that Mike will get into. Those are a type of mutual fund that obviously are aiming to match one of the indexes like the S&P 500, but Mike will get into more of that later. In the US, all mutual funds are regulated by the Securities and Exchange Commission, or the SEC. That's the same government agency that regulates stocks and the exchanges in the United States. All the essential facts of your mutual fund are legally required to be disclosed to the public, and they are regulated with the same vigor as any other stock. As a result, they've become very safe and very popular. Due to those public disclosures that are mandatory and enforceable by the SEC, you can find out exactly what that fund is doing with your money, exactly what they hold, and what assets, what stocks, and what commodities. And you can see the movements that those professionally managed funds are making behind the scenes. You will have full transparency with your money. These mutual funds have become so popular that, as I said in the intro, they make up a lot of retirement saving assets and are perfect for long-term growth. In fact, they make up a quarter of most your average household investors' portfolios. Finally, there's the exchange traded fund, or the ETF. The ETF is not quite a mutual fund, but it is a type of investment fund that also trades on stock exchanges. ETFs can hold stock, but often they also hold other securities, such as bonds, currencies, or commodities, and that's really where they shine. For example, if you want gold in your portfolio, but you don't want to literally buy gold bars or bullion yourself, there are gold ETFs that you can buy shares of. You can even do the same thing if you want to invest in the oil as a commodity, but not an actual oil company. You can buy ETFs that literally hold barrels of oil, and therefore, when the price rises of oil just like a stock, you too can make money by owning that ETF. ETFs typically have very cheap fees, but as always with any fund that you're going to get in, verify what those fees are and make sure that you're comfortable with them. Obviously, every mutual fund is going to say their fees are worth it for what they provide, but you want to compare them. Sometimes the exact same S&P 500 fund, for example, one company will have lower fees than another because they're doing different things behind the scenes. So always verify what those fees are and make sure you're getting a competitive rate that works for you, that you're okay with. Each fund has its own specific goals and strategies. but they allow you to put money in the stock market for growth if you're uncomfortable with picking individual stocks. This is why I personally think that they're the perfect entry point for investing. Obviously, to each their own, and you must always do your own research. We are not professionals, we are simply sharing with you the information to make you comfortable with getting into the market. Speaking of sharing that information, now we're going to go over to Mike so he can give us more information on index funds.
Thanks, Troy, for giving us a little bit more information about mutual funds. Now let's talk about index funds. Index funds are very similar to mutual funds. So similar, in fact, that all index funds are technically mutual funds, but don't get caught up on that. Now let's explore why index funds may be the right investment vehicle for you. As we previously learned, mutual funds are managed by fund managers, meaning they are actively managed. And by that meaning that the fund manager is going to pick which stocks get added in and out of the fund and what the allocation of those stocks are. Index funds are a little bit different. Index funds actually track a specific index. Index that you probably heard of is the S&P 500, which is a collection of the top 500 stocks, U.S. stocks. And what an index fund would do is it would track those stocks that are included in the S&P 500. So if a stock gets added or removed, the index fund is set up with a formula or algorithm, if you will, that will automatically balance itself to mirror what's in the S&P 500. So this means that the index fund is passively managed, which means that it's not a fund manager actively just having to make decisions and do research to decide what gets added and removed from the index fund. This also means that because of this, the expense ratio of an index fund is tremendously less than that of a mutual fund. We're talking about fractions of a percent. The expense ratio of an index fund would be versus maybe 1 to 2% for a mutual fund, traditional mutual fund. This is attractive to a lot of people because this savings doesn't sound like a lot, but over time it can add up to 50, 60, even $100,000 of a difference if you're looking at 15, 20, 30 years of investment time, and that's a lot of money. But some people like the comfort of having a mutual fund being actively managed. And some people say, hey, let's track the index because over time, the stock market always increases and I know I'm getting steady returns. So it really depends on what you like to tell yourself to. I suggest index funds because of the low expense ratio. They tend to do just as well as mutual funds in my opinion, but that's up to you to do your independent research on. But that's just one thing to consider when you're looking at an index fund to pick as your next investment vehicle. Now, right now, you're thinking, this index fund sounds pretty good. Why would I get in a mutual fund if I have to pay more money? And the index fund is cheaper and it's going to track all the top companies in the U.S. or specific given index. Well, there is a downside to it. And the downside is that since it's an index, let's say back to our S&P 500 example, if that were to take a huge dip, the index fund would take a big dip along with it. Because it's not actively managed, it's passively managed, it's just going to track what the S&P 500 does. So all the losses it takes, it's going to take as well. Versus that of traditional mutual fund that's actively managed, you can make the argument that the fund manager may foresee something coming, may be able to limit some of the losses by doing some moves within the fund to help limit some of the losses because it's actively managed. So I would be remiss if I didn't mention that is also something to consider when you're picking which fund is right for you. One more thing that I would be remiss if I didn't mention are ETFs, which are exchange traded funds. Now, ETFs are essentially index funds but they can be traded like stocks. Traditional index fund, you can only buy or sell once during the day, during a particular trading day. ETFs, they can be traded like stocks. You can do multiple trades throughout the day. Other than that, there's no major difference between the two of them. I would recommend to stick with index funds because the goal behind investing in an index fund or mutual fund is for long-term growth and kind of want to let your money sit there and grow. With ETFs, you might get a little tempted to pull your money in and out with that flexibility of being able to trade. But outside of that, that's what the ETF is. I just want to make sure you were in the know. And that's it, guys. That's all you need to know about getting started and investing in funds. Whether you pick a mutual fund, an index fund, or an ETF, it really doesn't matter. The most important thing is that you get involved and you get invested. I know myself and Troy personally, we both do mutual and index funds, and there's reasons behind that. And you have to pick a fund that is right for you. If it's still really too daunting, too much, you don't want to sit there and read the prospectus of every single fund. It's a lot still going over your head. Just go ahead and get involved with an index fund that tracks the S&P 500. Over time, historically, those funds have done great, and they're very good funds to be involved with, and they will start to generate some long-term wealth for you guys. Remember that compound interest snowball we were talking about? Let's get the ball rolling with that and really start chasing down financial freedom and empowerment. So thanks, guys, for watching the video. We really, really appreciate it. Please, if you don't mind, just hitting that like button is right there. Just go ahead and just hit that like button. What that does is it promotes our video through the YouTube algorithm to make sure it's in the recommendation list on top of search lists so other people can find this good content. Also, please make sure that you subscribe and comment if you have any questions or if you want to see us tackle a particular subject. We'll be looking at the comments and monitoring those. So once again, it's been a pleasure talking to you guys. We really look forward to going down this road to financial freedom with everyone. And here's to another episode of In the Black.